Hey guys, welcome to Aetherium Capital. For those of you guys who don't know who I am, I manage around $400,000 as a long-term portfolio, and this value is constantly increasing as I am deploying more cash into the markets. So now let's talk about Google and why it's such an interesting buy, and why it's actually around 10% of my overall portfolio currently. So let's dive into the details. Let's go through the business overview. So the business overview actually consists of multiple businesses. Alphabet, you have your Google search, you have your YouTube, you have your cloud, you have your Waymo, you have your other bets, and you also have the fact that Alphabet is actually running an Android OS system and licensing it to other players. So here's a fun fact that you guys may not know. Alphabet actually owns around 7.5% of SpaceX. So now, after going through the business overview, which I'm sure everyone is extremely familiar with, let's go through to the bull thesis. So first of all, Alphabet, it will benefit greatly from AI in the cloud division. So your Google Cloud provider is one of the main providers other than your Amazon as well as your Azure. Amazon and Azure, they are the leaders in the cloud field, and Google is actually a newer player in the field, and they are actually having the third largest market share. So the growth of GCP is actually significant, about 30% compared to Azure's and Amazon's 19%. So the reason why I say that Alphabet will benefit greatly from AI is because currently around 30% of the algorithms and the coding that is written in the cloud in the GCP division is actually written by AI. Of course, it is checked by engineers as well, but around 30% of it is actually written by AI. So now let's talk about Alphabet's Waymo division. I believe that this over here is a division that people are not really taking into account because of the fact that Tesla could come out with a FSD that purely relies on your cameras instead of lidars. So for those of you guys who have no idea what the difference is, Waymo's automation vehicles, they are actually focusing on your lidar sensors. So instead of Tesla's focus on camera only and algorithms, Alphabet's Waymo division focuses on LiDAR, which makes it more expensive. So, personally, as someone who also has Tesla as well, I still believe that Tesla's model is a better way, but that doesn't mean that we can immediately discount Alphabet's Waymo division to zero, because due to technological advances, we could have a decrease in the price of LiDAR as well. And I believe that Tesla could also face regulatory barriers, especially if Trump is not able to turn around the markets. He could be voted out 2 years from now. So there's a lot of risk involved with Tesla. But currently, for Alphabet's Waymo division, since it is a small segment of the whole business, I believe that it is a small bet that could pay off largely in the future. Now we can talk about YouTube. YouTube is a significant portion of Google's ad revenue, and it also has a great moat. And even though most of us actually watch YouTube on our computers, on our handphones, in reality, in the TV sector, YouTube is actually gaining watching hours compared to Netflix and Prime Video, which is absolutely amazing. Lastly, your Google search. I'm sure a lot of you guys are worried about LLMs being taking it over. I'll explain in the next slide why I believe that this probably won't happen. So Google search is more resilient than people expected since the inception of your LLM ChatGPT back in 2022. The search revenue is actually increasing instead of declining. In fact, it actually increased more than expected than the historical average as well. So now let's go through the bad thesis. Some of you guys think that LLMs or the AI threats, they could actually take over search. However, you have to know that the business model of the large language models are completely different compared to Google search. So the way that LLMs they actually monetize or make money is actually via premium subscriptions, which is totally different from Google search business, which is the advertisement model. So LLMs like ChatGPT, they provide free models in hopes that people will pay for their premium models, and that's where they actually collect their money, not through advertisements. Google, however, monetizes it on a different way. It actually monetizes it using utilizing ads. So of course, some people could argue that when more people use LLMs, what happens is that there's less people that are using Google search, which makes it less valuable to the businesses that want to advertise their products. I agree with this thesis. However, in my opinion, I believe that LLMs and Google search, they are used for different functions. LLMs, you'll use them to actually find out, answer your queries, questions and queries on things that you want a deep analysis on. So, for example, what are the potential outcomes of this vs that? However, for basic information, you actually still use Google instead. And if you want to actually buy products or find a restaurant, most people, or 90% of the people, will actually go to Google instead of LLMs like ChatGPT. Now let's talk about the Wiz acquisition. I absolutely hate it. It is an insane valuation of 32 billion. So currently, Google has around 70 billion in cash, and the operating cash flow that they could bring in this year is probably around 50 to 60 billion dollars. However, you have to look at the fact that the Wiz acquisition is 32 billion, and they will have a capital expenditure of 75 billion. So instead of buying Wiz over for 32 billion, what I would prefer them to do, right, is to buy back Google shares. They are so cheap right now, and I have no idea why the management is not buying back shares. So of course, I probably can't judge them because I do not really have a technical understanding of the cloud service and cybersecurity companies. And what we have to do as a Google investor is to just put our faith into the management. Sundar Pichai, he's extremely conservative, and Google does have an incredible track record of acquisitions, such as your double click system, as well as YouTube. So this one, I'll just leave it to the side. I dislike it personally, but I think that maybe I am not seeing the potential benefits that it brings. Lastly, same with all technological companies. Currently, they have humongous capital expenditures to meet the demands of AI, and this may backfire if the return on invested capital is not significant. Now let's look at the valuation of Google. So take note, these valuations over here, they are extremely conservative. So for some information, the past 10 years, Google is actually growing their earnings per share at over 22%. And in the recent 1 to 2 years, instead of slowing down, the earnings per share growth is actually accelerating at a rate of around 33%. So this valuation over here, take note, is being extremely conservative. So for the base case scenario, what I did was I put a 10% earnings per share growth and a PE of around 19. So this 19p is extremely justified for your Google and is really, in my opinion, one of the lower ends. Take note, this valuation is a conservative valuation. And then now we have our best case scenario where it grows at around 12% and it has a 20 PE. Notice I didn't really put the PE very high because I believe that this negative sentiment on Google will actually last for quite a while. However, in the scenario where it does returns 12% and at a 20 PE, it will actually give you a present value of around 260, which implies almost close to a 30% to 40% margin of safety. So honestly, in my opinion, I believe that the best case scenario is the one that will actually occur. However, as investors, we have to be extremely conservative with our projections. And so I will also include a worst case scenario where Google grows 5% for the next 5 years, and after the 5 years, it grows at 10%, and it has a low PE of around 18. So combining the probabilities of each of them, we get an intrinsic value of Google at around $162.5, which actually really implies around a 15% or 10% margin of safety at today's prices. So let's look at the conclusion. In conclusion, I believe that Google is actually significantly undervalued and is really offering a good buying opportunity with a potentially good CAGR if AI actually helps it. So even with a conservative estimate, the intrinsic value of the stock is actually still undervalued by almost 15%. And I believe that Google, right, is unlikely to be touched by tariffs because they are not even selling any physical goods. So, of course, these tariffs, they are only implemented on things that are physical. However, there could be potentially new tariffs, such as digital tariffs, that are actually invoked. And this will actually impact Google as well as other technological sectors. So, in my opinion, if I was China and I want to hit back on America, and if I'm the EU and I want to hit back on America, what I would do is I would actually introduce a digital tax, which is basically taxing all of the services such as Microsoft OS in China, as well as Google services in the EU to actually prevent these services from being used. So this will actually wreak havoc in the technology sector. So honestly, I really do not believe that these digital tariffs could be implemented. But if it is implemented, you have to be prepared for the fact that these companies will actually continue to trade down for a further 20 or even 30%. I hope you guys enjoyed this video and see you guys in the next one.